Construction companies need to attract 349,000 new workers in 2026 just to keep up with demand. That's down from previous years, but analysts at Associated Builders and Contractors say their forecast could be conservative, meaning the real number might be much higher. The gap isn't about building more, it's about replacing people leaving the workforce. Here's the breakdown. Associated Builders and Contractors released their annual workforce shortage model in January 2026, and the headline figure represents net new workers, not total hiring. The construction industry needs to attract 349,000 net new workers this year to keep labor supply and demand in balance. That accounts for both replacement hires and positions created by growth in construction activity. The 2026 estimate marks a significant drop from recent forecasts. ABC predicted 439,000 workers would be needed in 2025, and in each of the 2 years before that, the industry required more than 500,000 new workers annually. The trend suggests the gap between available workers and industry demand has been narrowing, at least on paper. But the model also projects a rebound. ABC estimates the industry will need 456,000 workers in 2027 as construction spending growth resumes. The year-over-year variation reflects shifting expectations about how much money will flow into construction projects, which directly determines how many people companies need to hire. The question is whether 349,000 is realistic or whether the industry is headed for a tighter labor market than the model suggests.
The drop from previous years comes down to spending forecasts. ABC chief economist Anirban Basu attributed the lower 2026 estimate to modest construction spending growth projections for both 2026 and 2027. When spending growth slows, demand for labor follows. The model works by linking construction outlays to employment. ABC uses data from the U.S. Census Bureau's Construction Put in Place survey and the Bureau of Labor Statistics payroll employment figures to establish a historical relationship between how much gets spent and how many workers are needed. The conversion rate sits at approximately 3,450 jobs per $1 billion of additional construction spending. That means if spending growth forecasts are moderate, the worker demand calculation reflects that slowdown. The model doesn't just count bodies, it factors in current job openings, industry unemployment rates, and projected retirements, then calculates how many net new workers are required to reach equilibrium between supply and demand. But here's the complication. The decline isn't necessarily good news. A smaller shortage doesn't mean the industry suddenly has enough workers. It means economists expect less construction activity than in previous years, which reduces how many people companies need to hire. The underlying labor supply problem hasn't been solved.
Most of the 349,000 workers needed in 2026 aren't for new projects. Basu stated that a majority of new worker demand this year will be attributable to retirement rather than increased demand for construction services. That holds true even with infrastructure buildouts and data center construction tied to AI expansion. The distinction matters because it reframes what the shortage actually represents. The industry isn't scrambling to staff a massive wave of new work, it's struggling to backfill positions as experienced workers age out of the workforce. The model accounts for this by adding projected industry retirements to the labor demand created by spending growth, then calculating the total number of net new workers required. This is why the 349,000 figure can drop from prior years while the underlying workforce challenge remains severe. Lower construction spending forecasts reduce the growth-driven portion of hiring needs, but retirements don't slow down based on economic projections. Workers retire on demographic timelines, not market cycles. The construction industry has had an age problem for years, and the 2026 model reflects that reality. Companies need to find hundreds of thousands of workers just to maintain current capacity, regardless of whether new projects materialize. That creates a baseline hiring requirement that exists independent of economic conditions, and it's the larger share of the 2026 number. So what happens if spending forecasts turn out to be wrong? Basu acknowledged the model's projections could prove overly conservative if project financing costs decline unexpectedly or policy uncertainty resolves quickly and favorably. Construction spending could accelerate faster than current forecasts anticipate, which would push labor demand higher than 349,000. The spending forecasts embedded in the model rely on assumptions about interest rates, regulatory environments, and economic conditions. Those assumptions can shift. Lower financing costs make projects more viable, and reduced policy uncertainty gives developers confidence to move forward with plans that might otherwise sit on hold. That creates asymmetric risk in the forecast. The model calculates demand based on what economists currently expect spending to do, but it can't predict political decisions or sudden changes in credit markets. If those factors move in a direction that accelerates construction activity, the 349,000 figure becomes a floor rather than a ceiling. The concern isn't abstract. Non-residential specialty trade contractors have already added 95,000 jobs since August 2024, signaling strength in some sectors even as overall forecasts remain modest. If that momentum continues or spreads to other parts of the industry, companies could face far tighter labor markets than the model suggests, which brings up the question of where those workers will actually come from. The industry faces a basic math problem on the supply side. The workforce is aging, and the rate at which experienced workers retire outpaces the rate at which new workers enter construction careers. This isn't a temporary imbalance, it's a structural shift tied to demographic trends that have been building for years. There are potential bright spots. Data from the National Association of Home Builders indicates Gen Z workers are showing greater interest in construction careers compared to previous younger cohorts. If that trend holds, it could help offset some of the retirement-driven demand, though the sources don't specify whether interest is translating into actual hiring at the scale needed. Immigration policy adds another variable. Industry analysts describe it as a potential wildcard for labor supply. Data cited in the sources indicates that undocumented worker inflows fell precipitously in 2025, while voluntary deportations accelerated, which could tighten available labor pools depending on how enforcement and policy develop over the next year. ABC CEO Michael Bellaman framed the situation around multiple pressures: an aging and retiring workforce, immigration enforcement, high materials prices, tariffs, office vacancies, and rapidly evolving technologies. These dynamics don't operate in isolation. They compound each other, making workforce planning more complex than simply matching a number to a hiring target. The question becomes, what happens if the industry can't attract those 349,000 workers? To attract the needed workers will worsen labor shortages and place further upward pressure on labor costs, especially in certain occupations and regions. This isn't a uniform problem. Some trades and geographic areas already face tighter labor markets than others, and those gaps widen when companies compete for the same limited pool of available workers. Higher labor costs affect project economics. Contractors facing worker shortages either raise wages to compete for talent or delay projects due to insufficient staff. Both outcomes increase costs, which get passed through to project owners and clients. In markets where labor is already constrained, the pressure compounds quickly. The equilibrium the model targets, matching labor supply with demand, becomes harder to achieve when supply can't scale fast enough to meet baseline replacement needs. Even without major spending increases, the retirement-driven demand creates sustained hiring pressure that doesn't ease unless the industry fundamentally changes how it attracts and retains workers. The challenge extends beyond 2026, with 456,000 workers projected for 2027 and demographic trends continuing. The hiring requirement isn't temporary. Companies need strategies that work across multiple years, not short-term recruitment pushes. The 349,000 figure represents where the industry stands now, based on current spending forecasts and demographic projections. Whether that number holds depends on variables the model can't fully predict: financing conditions, policy decisions, and how quickly companies can build pipelines to replace retiring workers. The 2027 projection suggests the challenge isn't going away. If anything, it's a preview of sustained hiring pressure that extends beyond any single year's forecast. The question isn't just whether construction companies can find 349,000 workers in 2026. It's whether they can build systems that consistently deliver hundreds of thousands of new hires year after year. For more on how workforce trends are reshaping construction economics,